Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to BCI podcast number 60. This one is titled Combining in-the-Money Call Strikes with Stock Dividends to Provide Protection in Bear Markets. We're going to use a real-life example with Exxon Mobil Corp., which trades on the New York Stock Exchange under the ticker symbol XOM. Now we're going to have a look at some trades that Mauricio was generous enough to share with us while there was a trade war concern going on with China, and this was in May through June of 2019. On May 8th, Exxon Mobil, XOM, was purchased at $76.72. Right after that, Mauricio sold the in-the-money June 21st 75 call for $267. So it's approximately a 6-week return. Now, on May 10th, a few days after entering the trade, there was an ex-dividend date for XOM, which was paid on June 10th, 89 cents per share. So we're going to have a look at how the premium and the dividend impacted our break-even to protect when there were market concerns due to this trade war going on in China. Now, if we use the multiple tab of the Ellman calculator to take a look at how Mauricio structured the trade originally, we would enter a stock price of $76.72, an option premium of $267 with a strike price of $75 on this 6-week trade, which expires on June 21st. Now, the white cells of the multiple tab will then become populated, telling us that the break-even, which is the stock price minus the entire premium, is $74.05. But the actual time value profit on this trade is 1.3%, because we must deduct the intrinsic value of that premium, $1.72, which is the amount that the 75 strike is lower than current market value of $76.72. That $172 must be deducted from the $267 premium. Otherwise, we would be dramatically exaggerating our profits. Calculator will do this for us automatically. So we have a 6-week return of 1.3% as far as our initial time value return is concerned. Now, there's no upside potential because we're willing to sell our shares at a lower price than current market value. So if the price goes up, we do not participate in that share appreciation. That's the disadvantage of using in-the-money strikes. Now, the advantage of using in-the-money strikes is that time value profit, 1.3%, is protected by the intrinsic value component of the in-the-money strike, in this case, 2.2%. So what that's telling us is that we are guaranteed a 1.3% 6-week return as long as the price of Exxon Mobil does not decline by more than 2.2% by contract expiration. So that's how Mauricio structured the trade originally. Now that 1.3% annualizes out to 11%. Now we have to make a decision. Does this meet our initial time value return goal range when we sell options? We have to know what our goal is before determining whether or not this is an appropriate strike. And it's not the same for everybody. It varies from investor to investor. But if an annualized return of 11% meets the goal, then yes, this would be an appropriate trade with additional protection because we're using it in the money strike. So the break even then is lowered from $76.72 down to $74.05, once again deducting the entire premium from current market value. Of course, in the money strikes have the advantage of having that intrinsic value component, which at the money and out of the money strikes do not have. Therefore, the break even on in the money strikes is lower than at the money and out of the money strikes. All right, let's discuss for a moment the ex-dividend date factor. So the X date was 5/10. That's the date that we must own the shares in order to be eligible to receive the 89 cent per share or $89 per contract dividend, which would then be generated on June 10th. So we must own the shares by 5/10. Of course, the trade was initiated a few days before that, so that's not an issue. Now, if we do receive that dividend, our break even now would be lowered to 73.16. So not only did the option premium lower our break even, but now the dividend as well lowered our break even. And that would represent a 4.64% lower price than the purchase price. So you could see how by incorporating and using both option premium and dividends, we can protect to the downside fairly decently. Let's first discuss the advantages of this approach. Well, in a troubling or volatile defensive market environment, we have three factors lowering our break even. One is the time value component of the option. Since we're using an in-the-money strike, we now also have an intrinsic value component to our option premium. And finally, the dividend distribution. So those three factors lower our break even 3 levels below the price that we paid for the shares initially. Now, as you know, and I always say, every strategy has its drawbacks, and this is certainly no exception. Well, number one, there is a modest return, and that's also a reflection of using a blue chip company. They normally have less volatility, and therefore the premiums are a little bit lower. In this case, a time value return of 1.3%, annualizing out to 11%. This may or may not meet your goals. You have to make that decision before you enter a trade. Will this particular trade meet my goals? If yes, we move forward. If no, let's find either another strike or let's find a different security. Now, lowering our break even to that 4+% protection depends on receiving the dividend. And that's not guaranteed, because the most common reason for early exercise, where our shares are sold or taken away from us, is an ex-dividend date. So that's a possibility. It's rare, and I wouldn't worry too much about it, but I just want you to know that that is the main reason for early exercise when we sell an option. So let's summarize now. So there's a whole lot of topics here we kind of covered in 7 slides. Let's move on to the next one. Yes, folks, this is a sound and appropriate strategy for bear and volatile market conditions. You know, we're using in-the-money strikes, which is one of the most important things. We're using a low implied volatility security, and we're also combining it with an ex-dividend date. Now, I am a huge proponent of in-the-money strikes when we're looking to garner additional downside protection, and that would be in bear and volatile markets. For some of you out there listening to this podcast, in-the-money strikes may be appropriate in all market conditions, depending on if it helps you sleep better at night. Now, adding the dividend component will offer additional protection to the downside, but there are also additional considerations that come along with a dividend. And of course, the one that I mentioned, and most importantly, is that there's an enhanced possibility, rare as it is, of early exercise. And if it's going to occur, it'll normally occur the day prior to the ex-dividend date. Now, this early exercise is more likely when the strike is in the money and the time value component of the premium is less than the dividend about to be distributed. Because if the time value of the premium was greater than the dividend, why not just sell the option? Then that's from the vantage point of the option holder, not us, the option seller. So it makes more sense if the time value is greater than the dividend, just sell the option. You're making more money than if you exercise the option, bought the shares, and then captured the dividend. Now, X dates may or may not be a factor depending on how important retention of the shares are to you. Certainly in this particular strategy, it's important because we're factoring in dividend capture to lower our cost basis. But in traditional covered call writing, ex-dividend dates, for me, I could care less. But if you own the stock at a low cost basis, you don't want the shares sold because you might have to incur some negative tax issues if you're trading in non-sheltered accounts. Well, ex-dividend dates may be very important. So depending on the situation. Now, when there is a dividend, the stock will drop by the dividend amount on the X date. So it's not totally a free lunch here. And that makes it more likely for the price of the stock to drop below the strike price had there not been an X date. And buyers of calls will want to pay less when there's an X date because they know the value of the shares will decline by the dividend amount on the X dividend date. So they're not willing to pay full price. So that's another factor that we have to consider when we're placing our trades and incorporating an X dividend date. Overall, this, folks, is a solid strategy in bear and volatile market environments like when there was concern regarding trading with China. Let me close by saying we use the Ellman calculator. You can get a free copy of that on our website, www.thebluecollarinvestor.com. Just look for the free resources link on the top black bar. We also have a beginner's corner tutorial that's also for free on the top right of our web pages, one for covered call writing, one for selling cash secured puts. We have a myriad of blog articles I've written over the years. And if you look into the bluecollarinvestor.com store, we have products that will help you master, not just be pretty good at it, but master the strategies of covered call writing and selling cash secured puts. They include books, they include DVDs, online streaming programs, calculators, spreadsheets, trade planners, mentoring programs, and so much more on www.thebluecollarinvestor.com/store. Ladies and gentlemen, thank you so much for taking the time to listen to this BCI podcast number 60, combining in-the-money call options and stock dividends to provide protection in bear markets. Folks, I hope you enjoyed this podcast, and more importantly, I hope it puts some cash in your pocket. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.